Okay, wanted to bring you a little scenario. You got this client, they're out there, they make a ton of money, they drive a Lamborghini, they're all great. You go, you think you're going to be able to do a mortgage for them, and lo and behold, you get their tax returns and you find out, you know what, they write everything off. Has this ever happened? It happens all the time. And it's become harder and harder in the mortgage world today to get that self-employed client qualified. Go back to COVID. Heck, it was virtually impossible at times during COVID. They had all these overlays. So it got really hard. Well, I want to fast forward to today, and it is not that hard. So people think that self-employed is super hard. However, we've come a long way here recently with our non-QM loans and what we're able to offer to our clients via a bank statement loan. So there's bank statement loans, there's loans for 1099 employees and or 1099 self-employed individuals. And let me just give you a quick rundown of how these programs work. So the first kind of barrier is you must be self-employed. So I've got to be self-employed to do a loan for somebody that's self-employed. So that's thing number one. Thing number two, you've got to have at least a 660 credit score. That kind of gets you into the game because remember, risk equals rate. Credit scores go much below that, just becomes too risky. The third thing that you need to have is positive cash flow. So you need to have a bank statement showing money flowing in and out. You can't have a bunch of like bounce checks and stuff in there. So those are kind of the big pieces. And what they look at, they take your income, what you show consistently month in, month out. There's an expense factor. Could be as little as 10% if you're an Uber driver and you get a 1099 and your 1099 was for $100,000 for Uber. They're going to take a 10% expense ratio and give you $90,000 for income for the year. Even if you write your income down to $1,000 on your taxes, we don't care. We don't look at your tax return anymore. It's purely based on your cash flows. But if you're not a 1099, what you're probably looking at is an expense ratio somewhere between 20 and 80%, depending on what kind of business you have, how many employees, those kind of things. So there is a definite calculation. It can be done well before ordering appraisals or anything. In most cases, you'd be able to supply your bank statements, have this looked at within a matter of hours, know exactly what your income is and what you could qualify for. So here's some other things. 12 or 24 months. What else do you need to know? I just wanted to kind of walk you through a little thing here because sometimes people will be like, oh, well, the interest rate's higher. Well, you have to remember all interest rates are relative. Your bank statement only cares about how much money you have going in and out throughout the course of a month. No place on there, like you don't wear a badge on your chest that says what your interest rate is. And your checking account really doesn't care. It just cares how much money is going in and how much money is going out. So let's look at this. You're taking out a $300,000 loan amount and you pay a full 1.5% higher. Everybody else is paying 6, you're paying 8. Well, your yearly interest would be roughly $4,500. So you can do that, or maybe you could qualify and file your taxes for 2 years because you need to make roughly $100,000 to qualify for that. Filing taxes for 2 years at $100,000, you'd be paying $17,399. I gave you the math down here. I'll actually do a screenshot of this so you can see, but you'd be paying roughly $17,399 to the federal government in taxes for 1 year at $100,000 so you could qualify for said loan. Now you get yourself a good CPA, you write that $100,000 down to 65. You no longer qualify for a mortgage, full doc through Fannie Mae, Freddie Mac. However, you still qualify the other way. Your tax liability now goes down to $9,607, saving you $7,792. If you do that over a 2-year window that you'd have to qualify, you're looking $16,000 more. But right, you just take the difference between the two. You're saving some money here, probably $3,500 to $4,000 less. Like your checking account just likes that it's less. And now you're able to go out there and qualify for that loan, do those things, continue to live your life the way that you were. So real estate agents, mortgage brokers, anybody out in that space, self-employed people, don't just think because you couldn't qualify for a loan a couple of years ago that you still can't qualify today. There are people sitting out there right now that are self-employed that are not listing their home because they need to file their taxes, right? They're sitting on an extension. April 15th went and passed. Now they're sitting there. They need to file those taxes. Can I qualify or not? I don't know. Well, I'm here to tell you there are more options than you might think. Be sure you're dealing with somebody that's reputable, that understands these programs. Now, your banker that just does conventional loans and says, oh, yeah, I've got the program, I can get it. Understand, they do that every once in a while. This is not something they do day in, day out. So if you really want to get the real answer, DM, message us here. We're happy to help. We understand bank statement loans inside and out, and love to help you and your clients close more loans. And even if you need a good non-QM lender, I know those as well. That's it. Have a great day.